Hi, everybody. This is actually the first of the recorded webinars that we're going to be doing for the webinar service on virtueofselfishinvesting.com. We're implementing some new technology here. We're using this system. You can see up here, goview.com, which is put out by the same company that also puts out GoToWebinar and GoToMeeting. And as you know, we use GoToWebinar to do live webinars. Now, these will be taped when I'm using GoView. And whenever I think there's something interesting that we should be looking at, maybe a wrinkle or a twist in the market or some up-to-date action that needs some commentary, we're going to go to GoView. And so hopefully this works. We'll send you a link via email where you should be able to view this if in fact you're viewing it right now. So it should have worked for you. But anyways, what I'm noticing here is that the market direction model, as you all know, is on a buy signal, which is fine. We had a follow through day, I think 3 Thursdays ago, down in here where I'm circling with my cursor. And most people didn't believe this when it occurred, but it did occur, and the market has moved up higher since then. Now we've come up here and we're forming this cup formation, and notice how we pulled back for the last 2 days, even as we've had news about the budget debate going on in Congress, which has caused some sell-off, some consternation in the general market indexes. And also we've seen some leaders pulling back, and actually a bunch of them reversed on Wednesday and Thursday. I believe you've seen some of these things pull back off their recent peaks, things like Netflix. Baidu came off a little bit but recovered over the last 2 days, and a couple other stocks have reversed. But all that seems normal just within the context of their moves. So we're going to try and put this, or I'm going to try and put this into a broader context based on the work that I've done over the weekend. It's Saturday morning, August 9th. So I've had a chance to go through all my screens and go through all my charts, and I'm going to let you all in on what I'm looking at. There are some subtle things that I'm seeing here, and I think at best, or at worst rather, you want to be somewhat cautious. If you own leading stocks and they're up for you, fine. Play them methodically and use discipline when dealing with the positions, and don't get into panic mode. But we can see here that we had this follow today, and you come up towards the highs, and it looks like a cup pattern. And you notice the volume dropped off the last couple of days as you pull back. You're holding this magenta line, which is a 10-day moving average, and that looks okay. And you also notice the 2-day RSI. Now I'll let you in on a little secret. I use a 2-day RSI in this market just because I've noticed that it works in terms of finding short-term peaks in the market, or where you're kind of getting into a high-risk spot. So when you start to see it get up here, where I'm circling here with my cursor, you're trying to get aggressive. It generally isn't really a good idea. You notice when we get 3 peaks, generally we have a sell-off of some sort in here. When you get a series of peaks, you're starting to get a series of peaks here, and now you've broken down. Now you might say that this is getting oversold pretty quickly without coming off very much that's constructive. Maybe so, but one of the things that bothers me a little bit here is if you look at Investors Business Daily, you notice the NASDAQ accumulation distribution is D-, the S&P 500 is an E, and the NYSE Composite, which is a much broader index of stocks than the S&P or the Dow, is seeing the same thing. So you're not really seeing a lot of upside kind of thrust here. Something that's also very interesting is you're noticing here, bulls versus bears. You're down below 20%. You're at about 15.7% currently, and so the bull to bear ratio here is at levels that I don't think I've actually seen in 20 years of being in the market. So I'm not really sure what this means. I do know one thing: you got a lot of bulls in here, and you have almost no bears. They've all gone into a type of spring hibernation. And so I think this is a cautionary sign. If these indexes have had a follow through and coming out, normally you'd see the accumulation distributions being an A, or at least a B or a C, at least improving. And so you're really not seeing that. And I wonder why. It's a little bit unusual, and I think it raises a little bit of a yellow flag. I'm not going to say a red flag, because I think once you get a market direction model sell signal from Dr. K, then you know that we're probably likely going into a downtrend. But for now, this may be cautionary, and I would say if your long stocks are acting okay, then you want to stick with them, and just hang in there and let them do their thing. So what I want to look at, though, you got stocks like Netflix pulling down normally. It should build a handle, but one thing to note here is if you're down under the 10-day moving average, the magenta line here, the low of this day now defines whether you have a 10-day moving average violation. So if you come below this intraday low here, which is I think 131.03, somewhere around there, that would be a violation, and maybe it means the stock comes down more. It could pull into the 50-day, the 65-day is the black line, exponential 65-day, as you know, that I like to use. But one of the things here is it tends to hold that better than it does the blue 50-day. You notice that here, where it pulls down, it tends to hold the 65-day exponential moving average. But Netflix is somewhat of a much more volatile stock than something that acts much more smoothly. Now notice it's formed this big cup, so it's coming in. Now we own some Netflix, so we still like it here. I would like to see it build a normal handle, so it may need to come off. But you want to keep an eye on something like this. I think things like Baidu, NetEase, Sina, these are all acting okay. And it's interesting, you're starting to see a number of other Chinese stocks, Cha and Chu, and I even noticed Ctrip is starting to come up the right side. And all of this is occurring as the dollar is devaluing. Notice the dollar here breaking to a new low and gapping down. And when we talked about the dollar in our webinar this past Tuesday, we were talking about the potential for the dollar to make new lows, and here we go. You're breaking to the downside. But I do think that regardless of whether Congress comes up with a deal like they did last night, I guess just before midnight, compromise budget deal to make some cuts. When they're arguing over 10 billion or 30 billion or 60 billion in cuts relative to a 1.65 trillion dollar deficits, that's less than peanuts. It's basically shell fragments of the peanuts. So it's all kind of silly to me, but what does that mean? I think it means that bonds are probably headed lower and the dollar's headed lower. And what does that mean for precious metals? Well, they're going to go higher. Silver's still in an uptrend, and it still looks good. Gold just broke out, and I think if you have missed the silver move, then what you might consider is taking the gold position in here, simply because you're real close to the buy point of about 141. 15, 16, somewhere in there, around 140, let's just say, and you're up, only up about 2-3%. So this is still within buying range. If you had a pullback, I'd definitely be a buyer here. And you notice gold coming out of a long-term trend here. Let's take a look at the trend here, much longer term. And you notice that when it does come out of consolidations, it tends to have pretty decent moves here, here. This one never happened, but here you have a consolidation you ran out. So maybe now you're coming out of this consolidation area here. It reminds me a little bit of this, where you come out, try to make a new high, and then back and fill. This took a little bit longer. This is a shorter consolidation, which also could be telling you that the stock is starting, or not the stock, but the metal, gold is starting to accelerate to the upside. And with all the things going on in Washington right now, I think it makes perfect sense. So I do think that you want to be looking at gold here. So the other thing is the short side, and we haven't talked too much about that, because mainly I don't think once you have a follow-through day and the market direction models on a buy signal, if you're coming in and trying to short, the odds are not with you. And I'm going to tell you that I've tried to short F5. It's not really going anywhere yet, but this stock is coming down here. Let's see if I can find a little annotation tool here. See if I can draw a line here. Yeah, here you have your neckline in here, and the stock's, it's more or less hovering above the neckline. Here's your shoulder, your head here. You got the big break down the right side, and it's hovering around here, finding some resistance at the 10-day moving average. And I've been testing this. I can't really tell you whether it's weak or strong here. It seems to be kind of in no man's land, but they are coming out with earnings at the end of April, and it's possible it might just hover here until earnings come out and then maybe break to the downside, or it could bounce to the upside. But for the most part, I'm still watching some of these stocks. VMware has rallied right back into the 50-day. Some news on the stock, and it looks like it's trying to come out of here, but I'm not so sure. CRM is another stock that I've been watching. It's holding above its 50-day, and it's hanging in there okay. So you can see these aren't really developing into anything on the short side. Now, LVS has come all the way up, up into this area on the lows of the base, and you've rallied back up into this. Now, I've used Qualcomm as a precedent for this, and Qualcomm in 2000 had a climax top, and then it doodled around, tried to build a base, and then broke down and went straight through the 200-day moving average after a short little bounce there. Now, here you've come down to the 200-day, but of course, you can see how the general market influences patterns, because what we had is a follow through in here, the general market turn, so it lifts Las Vegas Sands with it. Now you've just lifted just above the 50-day moving average. It's possible this could start to roll over again if the market were. So this is one I'm keeping an eye on. And I also noticed, CIT Group, which is Citigroup, and I guess they issue credit cards. But this is broken down. This is kind of a head here. Here's your left shoulder, and here's your kind of right shoulder. It's pretty weak. It doesn't really come off here. But see how it finally breaks the 200-day moving average here. You might short this if you had a rally back up into the 200-day moving average. I'm also looking at stocks like Goldman Sachs, for instance, if we're going to get into the financials. I don't know what you'd call this, as a head, left shoulder, right shoulder. I'm not really too concerned with this. What I'm watching here is just for a breakdown. You notice here, here's the relative strength line. Your relative strength line moved to new lows while the stock has been moving to relative higher lows here as it's trended up. So you have a divergence here. You got the relative strength doing this. You got the stock moving up like that. You roll over, you kind of run out of gas, you reverse on Thursday, and you kind of roll back below the 50-day moving average and the 65-day exponential. And I'm wondering if this isn't something to keep an eye on the short side. But I noticed that the action there looks a little strange and somewhat weak. I see the same thing occurring in Google, where you have the relative strength line going down and you have the stock trying to rally. Notice how you gap down here, you rally back up on weak volume down in here, and you push into the 10-day moving average, the magenta line here. So I'm wondering if this isn't shortable, with the idea that it's going to test the 200-day moving average. So this is something I would watch for. So what you want to do with these stocks I'm talking about, you want to create a watch list for short sale targets, and you want to just be monitoring this list on a daily basis and intraday 2 or 3 times a day during market hours if you can. And I would suggest doing so maybe a half hour, 20 minutes after the open. Sometime around 9, 10 o'clock, which is the lunchtime lull, as we call it, and that's when stocks going to hang out, and you kind of get a picture of what they've done and where they might be turning for the rest of the day. But you're seeing this. Some other stocks, RCL, I've talked about. Here's your head up here. Here's your left shoulder. Here's your right shoulder, or your neckline. Boom, through here. Boom, you're breaking the neckline. Probably bounces off the 200-day, tries to roll up. Maybe it could be shorted again. I'm seeing the same thing in Carnival Cruise Lines. And this is actually a weaker pattern, because notice how the whole thing is leaning over to the right side. Something to keep in mind here is when you're looking at short sale patterns, with RCL, notice what you have here is you have a flat neckline. So that's not as weak as a declining neckline. An ascending neckline would be less, if you're up like this. That would be a little stronger, but here this one's pretty weak, and so now notice how you're breaking down here, and this stock looks like it may want to go lower. The relative strength is coming down very quickly, making a new low, and notice how the relative strength is just blowing to pieces as the stock just starts to break apart. So that's looking a little bit funky there. I've been watching stocks like Intrepid Potash, that's a little bit weak. Watching POT. And I'm just watching these bases, because if these things start to fail, notice how it's come back below its 50-day moving average after a couple of sharp sell-offs. You didn't really hold up near the peaks here. I was thinking if this is going to do a little double bottom type move, it should have held up a little tighter. Now, of course, we're in a QE2 market, so anything could happen here. But it's interesting to note that. But one of the drivers of the weakness has been Monsanto. And as far as I'm concerned, Monsanto is now something of a failed base here. And it could have probably been shorted coming down through the 65-day exponential 3 days ago. But it's come down now. I'd watch for a rally here. This looks pretty weak. And, of course, this reflects on the rest of the group. They've all pulled back. Agrium, Mosaic. Probably the strongest fertilizer is SQM, but that's a South American company. They're a little bit better positioned in terms of where their fertilizer is sold, so it seems to be holding up better. But I do note that Monsanto has now gone on my short sale target list as a potential stock to keep an eye on the short side. Coach is another one. You had a breakdown here. Here's your base. It fails here, and this is very typical action. It fails on the breakout immediately, goes below the 50-day moving average and the 65-day exponential. Rallies back up, to around the 20-day moving average, and then blows back to the downside on a couple of gap downs, then rallies back up into the 65-day moving average and it's rolling over again. This is probably shortable up here, but you know, in general, you're not going to be looking for this as the market is rallying. You're going to be looking for long ideas, and of course, that's, you know, where your better plays are. In fact, if you had been buying silver, or you'd be doing much better than trying to short something like this. But notice here, the stock has not made a new low, but the relative strength has made a new low. So this thing, to me, looks like it may be ready to bust the 50-day moving average if we get some kind of a market rollover. And I'm not saying necessarily that the market is going to roll over, but there are some things to be keeping an eye on here, and I think they could be telling. Here's Apple. Same thing here. You see the relative strength line. The relative strength line is broken to the 200-day moving average, at least the way I have it on this chart. By the way, I'm using High Growth Stock Investor software here, one of my favorite tools on the weekend. Gives me a little bit different view than the other stuff that you might use. And as I've said before, this is a great value for about $600 a year. It really gives you everything you need. And I would note that these guys did recently put a pocket pivot screen on stocks. I'm going to see if I can bring it up here for you. Here we go. Now this is going to screen for pocket pivots, and what I can also do here is bring up a pocket pivot chart. Now notice how they do this. This is beautiful. We help them work on this, and it gives you a blue bar running all the way up and down whenever we have something that defines or fits the pocket pivot type move. But anyways, that's my little I don't know if you call it an advertisement or whatever, but my little discussion on HGS Investor software, which I think is some great stuff. These guys are doing a great job, and we really like their stuff. Anyways, let's see if I can come up with Apple again. There we go. Whoops, here we go. So what you're seeing here is Apple is breaking down. Let me get back to my normal charts here. Here we go. You got the relative strength making a new low long before the stock, okay, and it can't seem to hold either the 50-day or the 65-day exponential. Notice that once it breaks the 50-day simple moving average, the blue line here, you break down below the black 65-day exponential moving average, and now you're starting to move lower. I think you're going to see this stock probably move lower and head towards the 200-day moving average. Anyways, that's all I've got now for the short side of the market. I think that you should keep some of these ideas in your back pocket. I do think, I actually think Apple is a short right here, and I would use probably the 65-day exponential as my stop, and I would look for the stock to head down towards the 200-day if the market weakens. You know, they're cutting the weighting of Apple roughly in half, I think, in the NASDAQ 100. I don't know how much of an effect that has, because it's not like there's a bunch of NASDAQ 100 index funds out there, which would be the funds that would be dumping the stock. But I do think that the stock overall is showing you something of the old dome of death type of pattern. I know when I was at O'Neill, the institutional investors that we advise, the big mutual fund managers, always love to talk about the dome of death as the stock sort of does this kind of rolling top pattern. In a way, it does kind of look like what I might call a split head, head and shoulders, you know, where you might take this as a big head and the right shoulder. So that's something to keep an eye on. I just wanted to keep you guys alerted to what we're looking at in the market in real time, which is the intention of these webinars. And so I'm going to sign off here, and hopefully everybody's able to view this without any hitches. If you have any problems, please let us know, and I look forward to doing this again on goview.com. Take care.